My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Lobo Tigre, the due diligence guy himself on Twitter. We're going to be talking about a lot of different topics here. Lobo, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in markets? And is due diligence still a thing nowadays?
We could talk an hour just about that intro, but I do appreciate it. And maybe, that is the perfect place to start, because we have all these interviews and podcasts. We have some guru, sharing their inestimable wisdom and their secret CIA contacts, telling you what the future will be, what the price of gold to 5 decimals will be, 3 weeks from now, 3 years from now, whatever. And that's not me. I am a due diligence guy. How I came at this was being the due diligence guy for Doug Casey for 14 years at Casey Research before that went away. And now I apply that experience to my contacts in industry for my readers and clients. And so the distinction I'm making here is that, if you're going to ask me what the price of gold is going to be or where the economy is going to go, people ask me these things and I'll tell them what I think and, how I'm investing. But I don't pretend to know. I don't pretend to have a crystal ball or, or to know any more than anyone in your audience. But I call it like I see it, and I share what I'm doing in my publications with my own hard-earned money. But my specialty is due diligence. That really is a thing. Had somebody on Twitter push back on me and say, don't make me laugh. Only the big banks on Wall Street with, millions to throw at it can do any real due diligence. You can't compete against them. And I think that's a mistake. I think everybody can and should do at least whatever due diligence they can do. And you'd be surprised how much you can do. Google is a great democratizing force. We can all search at least the management histories of the companies that we're investing in, see if there's a history of lawsuits and failures in the past or success. That's at least a good start. And where we go from there, up to you. What do you want to? Where do you want to take the conversation?
All right. So all I heard from you in that last 3 minutes was that gold is going to 3,000. That's all I heard from you by year end. Okay, but hold on. There's a lot that you said which resonates with me. So I always use that line: "There are no gurus, only cycles." Right, and you can do a lot of due diligence on the micro level, but the macro ultimately is what makes the probabilities favor or not favor a particular thesis. And I'm with you. A lot of these mega banks that have all these dollars to throw at due diligence efforts. Let's face it, a lot of these due diligence efforts are just either CYA and or ways of trying to convince somebody to do a transaction. So that's why.
Just look at Sequoia and FTX. I mean, how much did that due diligence help them, spot an obvious scammer, make money to give it away? What a great business idea. Sorry.
Yeah, no, that's yes. Right. And so I share a lot of that cynicism around analysis. Now, I want to go a little bit deeper on this idea of what due diligence means nowadays. So you mentioned Google's a great equalizer, but the problem is, as we know, is that a lot of these searches are controlled by algorithms that might have their own agendas. Okay, in what they're showing, you can argue. We saw a lot of that with the Twitter stuff. How do you go about finding what the real truth is when you try to go and do due diligence? It's very easy to look at other reports and see if there's consensus. It's a whole nother dynamic to spend the time, effort to look underneath the hood, check every single gauge of the engine, right? And then on top of that, once you've done all that, it's not even clear if any of that matters because the market's basing all of its movement based on mistaken notions to begin with.
That's a whole nother rabbit hole. I don't think we need to go down that hole. But yes, the assumptions, the models, and people, flying by looking at instruments that are based on these models make lots of mistakes. But let's focus still on the due diligence part. At the very least, whatever biases there are in the search results, if you Google the management of everybody on the management team and the board of a company, whatever biases are there, you're going to get something, right? And if there is a history of bankruptcies or lawsuits or shareholder uprisings and so on, that will come out. Will you have perfect information? No, but you'll have more information than just sitting there and looking at their PowerPoint. You can go further, and if you are interested in making real money in this space, then you can't just sit at home and nickel and dime yourself to death. It's worth getting on a plane, going to PDAC or one of these other big conferences, and the teams are there. And if you look the guy in the eye, the CEO, and say, how much is this year's exploration going to cost? How much money do you have in the bank? And where do we go from here? And the guy can't answer the questions. Or, he looks at his feet and says, oh, let me check with my CFO. That's bullshit. The CEO has to know how much money he has and how much he's going to need to raise or not. And if he doesn't, he's incompetent. He's either lying or he's incompetent. And anybody can see this if they make an effort.
Do you get a sense that more of the industry is, in terms of CEO skills, is more about charisma and the way you talk as opposed to having real data and facts? And and it's not to denigrate CEOs or just the position in general, but
no, I get it. Doug Casey has his famous 8 Ps of resource stock evaluation, and promotion is one of those Ps. And it's not a negative. Like, people say, oh, he's just a promoter. Like, that's a criticism. But you see, I have seen companies where it's run by engineers and geologists, and they have really interesting rocks and interesting thesis, but zero ability to promote it, get the story out, and it goes nowhere. They even get positive results, and nobody notices. So there is absolutely something to that. And some of the most famous CEOs in the space, I think, excel at this. Your Friedlands and that sort of character. I'm not saying they have no other skills, but they are uber powerful salesman. I never go into a room with Robert Friedland with my wallet on me, because I'll leave it with it empty. It's just, he's that good at it. And that matters. You need to raise money. Exploration generates no revenue. It's very capital intensive. So somebody on the team has to do that. And does it have to be the CEO? Not necessarily. Some companies have CFOs who do that role, and the CEO is the geologist. But somebody on the team has to do that.
Right. I mean, and at the end of the day, this is ultimately about it's the role of the CEO is to instill confidence. Right now, that I think is a good transition to the banking panic. Okay, because if you're going to be talking about confidence, you got to be talking about where the flow of credit happens. I want to get your take on where are we in this, in quotes, crisis. I was very public as this regional bank crisis was coming out, with SVB saying, this to me looks like a manufactured, in quotes, crisis, because it's one way to provide an excuse for stimulus when you already have high inflation, which you can argue is what the balance sheet recovery ultimately was. But are we past this, in quotes, crisis, or is the bigger crisis still yet to come?
A couple pieces to that. The general answer is no. And I'm not sure about it being manufactured in order to do more money printing. I think that's still coming ahead. And if they did manufacture it, I mean, they really didn't do that much money printing. The balance sheet increased a little bit, but and it's going back down again. So, if that really was the goal, it makes no sense that they would have called it off so quickly. If they had that power to create this crisis, then why has it gone so quickly before they, achieved greater goals? And, where's the next Inflation Reduction Act? A good scare could have had Inflation Reduction Act 2, which would have spent even more trillions of dollars, right? So I'm not sure I see that as a likely explanation. But, one of the things that came out of this was a lot of commentators, and it was so consistent. Like, when you see the talking heads across different media platforms saying very similar things, it's hard not to suspect, at least, that somebody is feeding them a party line that they all toe. And on this one, it was dismissing the Fed breaking something. Like, oh, the Fed finally did break something. We all knew it was going to break something. And now it's done it. And it wasn't so bad. So, hey, everything's okay. Nipping that, or inoculating the population against that, or trying to convince investors that, the Fed, it has raised rates and it's done all the harm it's going to do, everything's going to be fine, seems like perhaps a more useful thing for the powers that be. I'm not saying, this is the case. It's just a thought experiment on my part. But what's more important to me, whether we can theorize about what's behind all it, I think what's more important is that I don't think the Fed is done breaking things. This panic, rather than a crisis, because they did nip it, is already quickly fading in the rearview mirror. Will there be knock-on effects? Absolutely. Will tighten credit have an economic impact? Absolutely. But that's yet to be seen. And even if the banking panic itself didn't have this effect, I think that the tightening that the Fed has done already, the rate, people talk about how Volcker raised interest rates to 20%. Yeah, but he did that from 15%. This is going from 0 to 5, and faster than a Corvette. So I think that has consequences that we've yet to see play out. I think more things are and will breaking. I think the so-called strength of the consumer and the strong labor market is a false positive. When companies had so much trouble hiring people after the pandemic, they were reluctant to let people go, even though they weren't doing anything. And now that last pillar of strength in the U.S. economy, the labor market, is starting to go visibly, and I think that's quite concerning. I do think we're headed for a recession. And I think it's going to be bad. I think, this loony concept of immaculate disinflation, people aren't talking about that so much anymore. Soft landing's gone out the window. And the argument now has moved to, how hard is it going to be? And I think it's going to be much harder than the center of discussion seems to imagine.
Historically, the playbook for that is, play in quotes risk off asset classes, right? Gold, the dollar, treasuries, which we should spend a little time on, and then on a relative basis, utilities, right? As sort of a defensive, must-need type of sector of the stock market. The dollar had its move last year, right? Was the clear beneficiary from a risk-off perspective. Gold is getting some good momentum. I think that's probably going to continue. In the context of sort of the idea of a hard recession, we already have an inverted yield curve. For those that are looking more towards treasuries as an investment as opposed to a tactical trade, do you think that it makes sense to go into the truest, pristine, safe haven asset?
Yeah, I get it. But it depends, I suppose, on what you mean by as an investment. If you're actually looking for positive gains, on your capital, then no, it doesn't make sense. The real yields are still negative. You'll hear some of the talking heads on financial media talking about, oh, we finally have positive real yields. Well, they're not actually positive now. That's assuming that the inflation models are correct when those bonds, bills, notes come to maturity, which certainly not for the bills. That's manifestly not true now. And for the notes and bonds, I think that's very unlikely to be true, even for the long bonds. And I should stipulate that I'm not a bond king here. I'm not a bond expert, but that's I think a point that is fairly clear to all. And you hear this talk about real yield now, and then you look at CPI and you look at the rate on a bond, and you're scratching your head. Well, what are they talking about? Well, what they're talking about is at maturity based on assumptions, not reality today. So reality today is any of these instruments, the best of them, is still guaranteeing you a loss. To my mind, that's not a great investment. Now, if you're in mortal fear of everything else being much worse, then as a defensive move, okay, I could see that. Particularly if there wasn't anything else I wanted to buy and I needed to park cash somewhere and my bank is still paying me some paltry fraction of a percent. Sure, short-term bills make sense as a defensive move, but I don't think of that as an investment. I'm not making any money there. I'm just, circling the wagons and hoping to still be there when the Indians stop shooting arrows.
Which probably is an interesting dynamic. It's like you always hear that argument, why would anybody invest in the stock market or YOLO in cryptocurrencies when they can get a guaranteed 4%? Well, because to your point, it's still guaranteed loss after inflation. So you might as well take the lottery ticket, right? And that's why.
Well, yeah, and there's risk and there's risk. I mean, take the lottery ticket. In my mind, that might be, Bitcoin is bottomed. Let's gamble on higher Bitcoin prices. That would be a gamble. Whereas if you have something that's clearly a trend in motion, you talked about the dollar, you talked about it having turned and the impact on, amongst other things, gold. And I'm not an anti-Bitcoin person, and I'm not always only gold kind of person either. But I'm looking at the trends, and in my view, what happens next with Bitcoin is a huge question mark. And the assumption that it must go up because it's gone down, I think, is just an assumption. It's not based on any. The track record is so short there that it's hard to defend saying, no, this is the most likely outcome, I think, in any rigorous way. Whereas with what's happening with monetary metals right now, you had the dollar have its day in the sun last year, as you pointed out. That has turned. The bearish trend for the DXY is pretty strong, and that's very bullish for gold. Now, why is that happening and where does it go next? That's a longer conversation. My view is in the near term, though, the Fed led the way in tightening. The Fed will lead the way in easing. That's bearish dollar and bullish for alternatives, including the euro as well as gold, by the way, and silver too. But that I think changes in the not too distant future because the Europeans won't be far behind in their change in policy. So then we need to look at other variables. And I think real rates that we were talking about is a reason to remain bullish. That historically, for over 50 years now, is the most powerful driver in the gold dollar exchange ratio. So real rates being stubbornly negative, I think, is a trend that I'm willing to speculate on without really thinking of it as just tossing dice on a gamble. Does that make sense?
Yeah, and that does kind of lead to a bigger discussion around commodities having a cycle or a super cycle, or just metals within the commodity space having their own cycle. How do you think about sort of the argument that we're in a multi-year period where commodities in general, right? Let's kind of go top down, are the place to be. There's been a lot of big time commodity bulls, especially on the energy side of things, right? And I'd argue they've been right and wrong. A lot of the arguments have been right, but it's like a lot of the arguments here I still hear today around oil and natural gas are the same ones you could have said back in June when oil peaked, right? So how do you think about where we are in that sort of broader cycle, and if it's a cycle in the absence of a China infrastructure spend like we saw with the super cycle, what causes that cycle to accelerate?
Right. So this is one of those things where it's easier to call the trend, much harder to call the timing on the turns and twists. But I think for people that have the patience to look at this in a multi-year way, they're not looking at what's going to pop tomorrow or even necessarily just what's going to happen this year. People with a longer term horizon for their investments, I think you can look at the commodity super cycle as still a multi-decade wave that is experiencing volatility on the way up. And I think there are very strong reasons for that. Part of it recently is the new Iron Curtain, the war. I think that is a permanent change. We had the peace dividend after the collapse of the Soviet Union. That is being reversed now, and that isn't going away. Even if Putin accidentally steps in front of a bullet and Russia changes course suddenly, that won't make it go away. You still have China in opposition to the U.S. with a different agenda, different goals. I think we're looking at a world where deglobalization, reversal of the peace dividend means higher prices than they would otherwise be for commodities going forward. Then on top of that, you've got the green agenda, which is a huge multi-trillion-dollar push into all kinds of commodities, particularly the so-called critical minerals. But not only. And then you've got that same agenda making energy more expensive, choosing less efficient, subsidized energy sources and choking off the cheaper sources before the replacements are ready. And you can't just say, oh, well, that's just energy. Energy feeds into everything. You're going to make shoes, you need energy. You're going to grow food, you need energy. Actually, you literally make fertilizer with some hydrocarbons. So you make these things more expensive, you choke off the supply, everything gets more expensive. And then at the same time, you've got all this insane not in my backyard thinking where you've got the administration of the United States telling people to drill more. But don't worry, we think your business will still be necessary for at least 10 years. like that's going to justify building a $30 billion refinery. It's just crazy how you can see all these factors that are so bullish for demand, while the world is trying to, or at least the so-called developed world is trying to choke off supply. All of this, I think, again, for the patient, disciplined, long-term perspective is very bullish, and you can ride the ups and downs in the way. Now, granted, even I don't invest on a 5 or 10 year time horizon. I don't have that patience myself. So I'm saying this is a solid long-term trend. But the timing, getting the timing right and wiggles here and there, that's harder. And the one, I think, key point to keep in mind for now is that I think we're heading into a recession. I think the so-called strength of the U.S. labor market isn't real, and it will be revealed to be such this year. I think the recession deniers will be forced to admit reality this year. And that has always, in my experience and that of my mentors before me, that has always been very bearish for commodities. So the near term, and it's unlike me to make any big, bold prediction. I'm not trying to get you a clickbait headline here. I'm not saying what will happen when, but I will say that to my mind, and based on my experience, the odds favor an admission of recession in the United States and then around the globe this year, causing a real retreat in industrial minerals. your copper, even as necessary as it is, and as much as we see the supply shortages in the years ahead, I think copper takes it on the chin, nickel takes it on the chin, all these industrial minerals take it on the chin. And I don't think the reopening of China will be enough to keep oil headed higher in the face of that recession. It'll help. It'll be a countervailing factor. But anything industrial, I think you need to worry about. The possible exception there would be uranium, which is still below the cost of production and is baseload power. So it's not light discretionary energy spending like driving to grandma's for the weekend. And of course, monetary metals are not commodities like pork bellies or copper or something like that. They respond to safe haven demand and monetary issues. So a recession is not necessarily bad for gold and silver.
I mean, I would argue that a recession probably is very good for gold. I've been pretty consistent on this idea that for gold to have a secular cycle, you need some large institutional players believing that the bear market in beta will last for some time, because the reality is there are few real diversifiers when it comes to portfolio construction. Gold really doesn't correlate to very much. So in order for there to be sort of a self-fulfilling momentum cycle reallocation to gold, there needs to be belief that you need more diversification, which would only happen if you have a multi-year bear market, right? Which I think.
You're expressing something that our friend Rick Rule likes to comment on.
Yeah.
He tells us that the multi-decade mean of portfolio allocation to gold as a safe haven, it's not like everybody turns into gold bugs. But if you look over the last 40 years plus, the portfolio allocation is something like 2% to gold. And currently it's only 0.5%. So a mere reversion to the mean along the lines of what you're talking about would quadruple the investment demand for gold. And, this makes a lot of sense. It's a very, erudite mathematical way of looking at it. It's classic Rick Rule. But I think there's other factors. You mentioned institutions. Well, the biggest ones are central banks, and they've been net buyers, record buyers over the last year. And I don't want to. You asked me before when we talked about this interview about de-dollarization, so I guess we'll talk about that. But I think that's a very significant factor. And de-dollarization or not, just the new Iron Curtain, I think, is part of this whole thing. And to have central banks become, massive buyers on a record basis for gold, I think that's material. I think that is part of why we have seen gold do as well as it has, or in the face of in the face of less negative real rates, in the face of a rising dollar last year, I think central bank buying was a big factor there. But let me throw another different way of looking into the ring here. I don't think it's just the institutions. I think it's also a matter of the retail level. Now, the silver bug community was unable to put a silver squeeze on and force prices higher for long when they tried a couple years ago. But that's a very tiny, tiny slice of the overall investment world. That's not what I mean by retail. I'm talking the average investor, mom and pop out there. They're basically AWOL. They're just no interest. They're not in our markets at all. That can change. What characterized the 1970s, just mania that drove gold and silver so high, wasn't just institutions. It was the shoeshine boy, the bartender bragging about the gold coin he just bought. That sort of thing hasn't happened this time. The difference between the stagflation then and now, I think the biggest difference is this thing. And, inflation expectations, say what you will about Powell, he's managed to keep those tamped down pretty well. He and his cronies there at the Fed have managed to convince the average person out there that the Fed's got this. They're gonna beat inflation. And as long as that's the case, and you can look at the consumer expectations reports from University of Michigan and other places, and they expect the Fed to beat inflation. That in the near term, they think it's sticky, but give it more than a year, and they think that inflation is going back down to 2% in the not too distant future. And that's not the sort of thing that sparks a mania for alternatives to money losing value. So I think this is really important. I think when the average Joe realizes that inflation isn't going away, which is my position, I might be wrong, but if I'm right, when this starts sinking in and people start realizing that, I don't want to hold this hot potato. What are my alternatives? And people start thinking and looking back, well, what worked before? Well, the last time we had a situation like this, gold did well, silver did well. I think we could see a very substantial shift in the broader, larger retail investment world. that would blow away whatever the institutions might or might not do.
Obviously, a lot of people reference gold and silver, but is it just gold and silver, or are there other metals that would just have some broader correlation co-movement?
I'm glad you asked. I get a lot of hate on this subject because you've got platinum bulls out there or palladium bulls or rhodium or what have you. I think there's an important distinction between monetary metals and so-called precious metals. Just because something is expensive, it's precious, my precious, my precious. That doesn't actually make it a monetary metal. I mean, if somebody started minting palladium coins, would you be able to tell them from a silver coin? I couldn't. And I don't think anybody else can either, just looking at it. And you know what? Gold has for whatever its pluses and minuses are, it's got a very distinct look and weight and feel. It is a unique element that really helps. And even silver. Of the other silvery metals like platinum and palladium, they're all more expensive than silver. Nobody would mistake tin or aluminum for silver. They're very different. But from the silvery metals, silver is the cheapest. So you don't have to worry about somebody substituting platinum for your silver. It's not going to happen. So I'm not just being theoretical here. I think this matters. There's a reason why gold and silver have circulated as money, and that matters. I think they're monetary metals. And when people are looking at monetary phenomenon, that's the go-to space. Now, on a short-term basis, like on a day-to-day, intraday basis, if you look at the charts, you'll see platinum and palladium wiggle up and down with gold and silver. Like whatever scare sends people piling into gold and secondarily into silver, some of it seems to spill over into other expensive metals, so-called other precious metals. But that's just on an intraday basis. If you look at the broader charts, even just on a year basis, let alone longer charts, it's very clear that platinum is an industrial metal. Palladium is an industrial metal. And they respond primarily over time to industrial impulses. And if you're as confident that we're headed for recession as I am, then there's no reason to be betting on platinum and palladium this year. There's no reason to expect them to catch up, especially if you think, platinum is rarer than gold, therefore it should be more expensive than gold. Even if I accepted that, but it's demand, not just it's supply and demand, not just supply that determines prices. So, but even if I accepted that platinum is rare and should be more expensive than gold, I still wouldn't buy it this year with recession clearly looming ahead. So yeah, I think that's an important difference, and it makes a difference to our investment choices now.
Everybody, please make sure you follow Lobo Tigre here on Twitter. I know stagflation is a big belief, and a lot of people reference stagflation. I don't necessarily disagree. The problem that I have with the stagflation argument is I don't see how a system with $31+ trillion of debt, let alone 300 trillion globally, can survive under stagflation. All right, it's like all the arguments around this is like the 70s. Okay, in the 70s you didn't have the debt to GDP where it is today. All right, if we are in this kind of stagflation period, how long can we actually stay in that state?
Yeah, I understand. I think part of the issue here is definitional. Many people see stagflation as just weak growth and high inflation, but it's still growth, not recession. Whereas I'm willing to include actual recession and high inflation as a kind of stagflation. It's more than stagnant, I suppose. But you still have this combination of economic weakness and high inflation. So when I say I expect stagflation and I expect it to last, it's not saying that I expect weak growth. I'm saying I expect an inflationary recession, which the mainstream doesn't even think is possible. Like the models that most economists work from, recessions are deflationary. Growth generates inflation. They don't think inflation comes from the money supply. It has nothing to do with always and everywhere a monetary phenomenon. No. Inflation somehow magically just comes from confidence or growth somehow. Where I disagree. I think it is always and everywhere, even if long and variable lags mask the effect, a monetary phenomenon. So I think it is quite possible to have inflation and recession at the same time. And honestly, if people would just sort of get off their high horse and look at the real world, you can see examples of this. I mean, just Zimbabwe recently, you can have an economy tanking and be paying $100 trillion for an egg. Clearly, it is possible to have inflation and a recession. That's what I mean when I talk about stagflation. Many branches we can take the conversation there, but to answer your question, I agree. I think there's a great deal more fragility in the so-called developed world than is recognized. I think there's a great deal more danger in the Fed breaking something you know than they will admit. And I think we're about to find out. Now, does that mean that this is it? Go to the bunker in Idaho and hunker down, don't come out for 10 years? No, I'm not saying that. We'll see. The powers that be have proven as incompetent on other things. They've proven exceptionally competent at kicking the can down the road. And I can't say that they won't somehow pull it off again. I can say that if they do, it will be incredibly inflationary. And even if that masks the real weakness in the economy, you can have GDP numbers looking great because of how, how ill-defined they are and how crazy they are, even if the reality is that people are getting poor. This is why my friend and mentor Doug Casey, he doesn't define a recession in terms of quarters of negative GDP growth in the deepest case in a depression. He looks at what happens to the standard of living of the average person. If it's not growing, if it's going the wrong way, then whatever you call it or whatever the GDP is doing, that's bad. And that's where I think we're headed. And sooner or later, I think we're going through that meat grinder. I like I started out saying, I don't have a crystal ball, so I don't know exactly the timing of how this works out. But I'll tell you what, I'd much rather have a solid savings in bullion, gold and silver, and be wrong for a couple years than to not have it and be right sooner than I expect.
By the way, that point about the standard of living, I've joked about that before. It's like, I'd argue that the whole push for metaverse and living your life online is meant to prevent people from thinking about just how poor the standard of living is becoming in the U.S. It's just
that's a scary thought. I mean, in the movie Ready Player One, remember what the world looks like outside of the artificial world.
Right. I mean, you can argue even with the Matrix. I mean, it's kind of the same, idea, right? You're in a digital world.
That would be the extreme. Yeah.
Right. So but it is interesting, right? Because it's the timing of the technological push on the metaverse with all this coinciding is, I don't know if it's fourth turning-esque or not, but it is kind of remarkable. Okay. Now you had alluded to uranium nuclear renaissance. I want to dovetail that to ESG. I would have thought with all the narratives around oil, gas, commodities that ESG would take a back seat, right? That a lot of the ESG narratives were countered last year, and ESG is not going away. Doesn't seem to be any kind of stopping of the flow of funds that are going there. And a big part of ESG investing does need to include nuclear, but it seems to not get as much traction. What's the thesis for you on the uranium nuclear side?
I think you've in a way laid out the thesis, but my difference would be I would disagree, I guess, that ESG is being a problem here. I think actually ESG is becoming a big push for nuclear. Yes, there's still people that are objecting. There's still groups that are dragging their feet. But the center of debate has shifted massively in favor of nuclear. You've got, long-term left-leaning rags in the U.S. and around the world even asking the question, is it time to reconsider nuclear? I mean, this is a ground moving under our feet kind of event. And you've got, even Greta said that Germany should not shut down its last nuclear power plants. That's huge. Whether you like her or not, agree with her or not, but there's entire younger generations that listen to what she says. So to have that idea even injected into the conversation is massive. And I think if you look at the balance around the world, we can't let ourselves be too culture centric here. Sure, the debate in Germany, if you happen to live there, or in the US, is still pretty hostile to nuclear. But even in those places, it's at least a debate now, where it was just a closed issue before. That's a giant change. And almost everywhere else, the world is charging ahead. The BRICS countries are charging ahead. There's something like over 400 reactors on the drawing boards. And I don't remember what the number is for the ones actually under construction, but there's a dozen or so around the world. And it's not just BRICS countries. The Eastern Europeans have a very practical frame of mind. And Germany's dragging its feet, but it's now, one of I don't know how many countries in the EU. And the balance there has shifted. You've got Poland and farther east. They can't wait to build more reactors. And even the UK is talking about small, advanced nuclear, and even the Biden administration isn't just talking about it. They're putting money into it. There are billions of dollars that are now being pushed for researching advanced nuclear in the U.S. under the current administration. So I think this is an idea whose time has come. It doesn't mean that nobody objects overnight, but not only has the balance shifted, I think the momentum is now in favor of this new nuclear renaissance. I think it would take something on a Chernobyl level to derail that. Now, I always mention that. My uranium bug fellows friends there, they hate it when I do this because it's scary. But that's a real thing. And as confident as I am in the uranium thesis, which I think is one of the most solid speculative investment theses in the world today. And unlike copper or many of these other important minerals, like I mentioned before, the cost of production is higher on average around the world than the spot price remains today. That can't last. That makes it almost a slam dunk that prices have to go higher. Like I say, with this one exception. And I think this is worth remembering. If you're going to speculate on uranium, as solid as the thesis may look, you can convince yourself this is just an ironclad. But if there is another Chernobyl type event, all of our stocks can just melt down with the reactor. It would be bad. There's no escaping that. And I think anybody that goes into the space needs to understand that they are speculating. It's not guaranteed. But you know what? Those incidents are very rare. Each time we learn, and look at Fukushima, as bad as that was, it was, in the first place, a tsunami. In the second place, problem's been fixed. And, it's been a long time since Chernobyl. And I don't think it would happen again. So we'll see. But I want to stress that this has become a huge part of my personal portfolio. I put a lot of money into this because I'm that confident that the world is going nuclear again. But I don't kid myself that nothing bad could happen.
Let's go to some of the audience.
Thank you very much for the question. Good question. Well, first, I would just pause and say something about ETFs. If I'm not a fan of the ETFs, and when there's a raging bull market and the ETFs are a good proxy for the market, if you don't have time to do due diligence and pick stocks, then maybe an ETF in some sector that you're a fan of is not a bad thing. But I think if you're willing to put the mental effort in and do some due diligence, I think most intelligent people could do better than a lot of these ETFs. I'm just not a fan as a general thing. But on this particular one, or transition metals, I think it's important to be pretty choosy on your commodities too. In the same way, I think I can pick better companies than the average ETF out there. I also think that one needs to be choosy about one's metals. And you get a thesis, this big idea, the electric cars are coming, and that doesn't necessarily, the rising tide doesn't have to lift all boats. And we see already, for example, in the electric cars that the LFP batteries are coming along and really gaining market share rapidly. These were previously dismissed as too short range, not good enough, blah, blah, blah. But the battery technology itself is improving. The newest designs are close to on par with the nickel manganese batteries, but they don't have any nickel in them, any cobalt in them, and they're cheaper and they don't catch fire so easily. So I think we're getting to a tipping point where the LFP chemistry is actually going to be the superior and preferred chemistry. And also, as the charging infrastructure builds out, then the range anxiety just goes away. Nobody has range anxiety about a gas-powered car. I know it will take time, but the world is moving in that direction for the electric cars too. So I think it's dangerous to put all of these, battery-related or vaguely green minerals all together in one basket. You need to look at how the technology is changing. You need to look at which ones are actually in short supply and which ones aren't. Some of these are actually quite abundant. So one size doesn't fit all. If I can toot my horn here a little bit, I've got a free report that's downloadable on our website if you go to the free report section on nickel and one on lithium. And in nickel, I made the argument before prices tanked that it really wasn't that uncommon. And the perceived shortage had to do with defining nickel as so-called class one that trades on the LME. But there's plenty of other nickel around the world, and we're seeing Indonesia stepping up to the plate there pretty much exactly as I called it. I don't pretend to know the future, but that was a trend that was visibly in motion. So we could spend a lot of time talking about all the individual metals. I'm just saying, I think it's important to do your homework here. And therefore, I would not put my own money into a basket that was just so-called green minerals or transition metals or something. I'd want to pick and choose my own metals and my own stocks.
So that's a good going full circle to the due diligence point of the discussion at the start. How do people get a true handle on the likelihood of certain metals or certain commodities going up or down or going up faster? Or what sources do you go to that help you come to your conclusions?
That is a bit more research. And I guess the most helpful immediate thing to say is I don't listen to anybody who's in that commodity themselves. If there's a guy who's got a copper company, he's telling me how great the outlook is for copper, that is not an unbiased source. Whereas if I'm talking to the CEO of a silver company and he's telling me, well, you know what, I'm also really bullish on copper and here's why, well, that catches my attention. There are also independent agencies out there, not to mention the independent speculator too much. We're there, but there's big engineering firms like Wood Mackenzie and others that produce reports on this. They may have their flaws. They may have their assumptions that we may or may not agree with, but at least they're not just a copper guy talking up copper or a silver guy talking up silver or gal, as the case may be. So we're not just floundering around in the dark. There is material out there if you care to look for it.
Final subject to cover, and then we'll wrap up. I want to hit on AI, and I've been having a little bit of fun with AI the last couple of weeks. Even these Twitter spaces, I'm now using AI to basically come up with the titles. I literally copied and pasted what you DM me as far as topics, right? Put that in, came up with a Twitter space name, then came up with a whole tweet that was AI driven. And this is kind of me more experimenting just to see how good this is at grabbing attention. And it is pretty remarkable despite my initial skepticism. What are some of the implications from your perspective on AI when it comes to the economy? And then maybe how does AI impact the commodity space? I'm going to have to assume that AI is not necessarily going to help you figure out which mines will get you more of a particular metal, but maybe I'm wrong.
Yeah, well, okay, right. With the caveat that I'm certainly not an IT specialist, and I don't even just mean as an investor. The technology. So I'm not a programmer. I learned Fortran decades ago. That's how dated my knowledge is on programming. But as an investor and as a futurist, as a person watching the world looking at this, I think first, I think it is important not to dismiss this. Like, this is a real thing. This is happening. It will change and touch almost everything. Smart technologies that help us are tools. It's like the ultimate Swiss Army knife that can help us with almost everything. And I see that as a net positive, sure, creative destruction. There will be a lot of jobs that go away. That whoever you had paid full time to write Twitter titles for you, they just lost their job, right? That's the real thing. I'm joking a little bit, but that's happening. Okay, so we need to understand, and I think this is worth thinking about. How is the world changing? What does that mean for my job, or if I'm retired, my children's job? That sort of thing. Okay. That said, I'm not Ray Kurzweil. I'm not going to crystal ball about the future. I could write a science fiction story, but I wouldn't know any better than anybody else. In my world, I'm not worried about my job. And it's not just sticking my head in the sand. I hope there's actual experience here. There are several companies applying AI to mineral exploration. And there's certainly, I think, everybody on Wall Street is doing their best to apply it to stock picking. And I haven't seen any of these guys or gals deliver the goods. The one company, it's called Goldspot that I can think of. There were others. They ended up folding shop on that. They kept getting all these new contracts to use their AI to look for things. And it was a very exciting story. The AI could do essentially millions of years of research and experiments in seconds that a geologist could never do. It made so much sense. But, what was absent were the headlines of this AI helped us make this multi-million ounce gold discovery or this multi-billion pound copper discovery. I just didn't see many of those, or now that I can think of it, any of those. And suddenly the thing's gone away. So I think it's important not to panic or overestimate the capacity of these things. We hear stories about like writing blurbs for real estate listings being taken over already by these bots instead of persons. That makes perfect sense to me. It's a rote task. Doesn't take much to put that information together. But the I mean, geologists with decades of experience and deep understanding, and if you want to think of it as heuristic and almost artistic insight, as well as the science in their heads, still have a terrible time predicting who's going to make a discovery, and the AIs that so far haven't really done any better that I can see. Eventually, somewhere down the road, maybe even mineral exploration will be something best done by AIs. But for the investable future, I think not. And that is important for the average investor out there. Who are you going to trust? Who are you going to listen to? And I would put more trust in myself and my own due diligence than somebody who says, "Oh yeah, we've got a robot that's going to do all this for us." I haven't seen that be successful yet.
From your lips to God's ears on that end, because I don't want our jobs to be obviously fully automated and replaced. I don't think they ever will be. I mean, at the end of the day, AI might be good at coming up with decisions, but people still need a story, and I think that human narrative is still going to matter at the end of the day. Everybody here again, please make sure you follow Lobo Tigre. I appreciate your flexibility in doing this space with me, and hopefully everybody will follow you here. Thank you, Lobo. I appreciate it.